I know it's tempting to buy energy stocks right now, especially with most pundits and newsletter writers urging you to buy right now before it's too late, before incredible bargains, courtesy of the big sell-off in oil prices, disappear forever. Heck, even Barron's, the popular financial news weekly, ran a headline this month, "Buy oil now, here's how." But before you push that buy button or call your broker, I urge you to watch this video through to the end. And if you own any energy stocks or master limited partnerships, please just review the research I'm about to present in this video before you buy more. In just a moment, I'll explain in detail why if you buy energy stocks right now, you're taking a huge risk. Yes, even some of the most popular and widely held energy stocks, the names that many see as rock-solid safety-first picks and that many pundits are telling you to buy, are actually very dangerous investments right now. Before I go any further, I must tell you the views in this video are controversial, and my research is bound to make some people very angry. If any of this bothers you, or if you're just looking for affirmation of a decision to buy energy stocks, you may want to click away right now. In this short video, I'm about to show you, in the simplest terms possible, why I believe that some of the best known and most widely owned energy stocks will fall an additional 50% or more before the middle of this year. How a recent chat with an energy industry insider, a conversation about his recent hunting trip no less, revealed a shocking risk for energy MLP investors that no one in the mainstream media is talking about. Believe me, I don't want to frighten you. I don't take my conclusions lightly. I'm not fear-mongering. However, I can't be silent about my latest research. I can't just sit back and watch many investors make a devastating mistake. Of course, the most important part isn't what's happening, but rather what you can do about it. As I'll explain in a moment, my research reveals there are some surprisingly simple steps you can take today to both protect what you've got and potentially make serious profits from trends in the energy industry. Listen, I know that if you're watching this video, you've probably been investing for years. Many of you probably have a ton of experience with energy stocks and groups like the Master Limited Partnerships, or MLPs. I wouldn't expect you to just believe me with no evidence or support. I know you're probably thinking that most energy stocks can't have that much downside left, not after last year's big sell-off. You might even be thinking, aren't these just the types of valuations that great investors like Warren Buffett salivate over? And that's why I created this video, to answer those questions and reveal some shocking risks in some of the world's largest and most respected energy stocks. All I'm asking is that you give my research in this video a look. I guarantee you won't be wasting your time. And the content of this video could help you avoid a serious financial hit in the energy space over the next few months. Challenge every single one of my facts, and you'll find that I'm right about each allegation I make. And then you can decide for yourself. But first, I should probably introduce myself. Hi, I'm Elliot Yu. I'm the co-founder and chief analyst for Energy and Income Advisor, a comprehensive financial research service dedicated to uncovering the best income and growth investment opportunities in the energy industry. I'm also co-host of Capitalist Times Radio, a finance and investment program broadcast on 880 AM The Biz in the Miami area. Co-founder Roger Conrad and I are not new to the financial advisory and research business. In fact, we have more than 40 years of combined experience as analysts and editors of some of the largest circulation financial publications in the United States. Our financial advisories have been consistently highly rated by the industry's only independent rating service, the Hulbert Financial Digest. You may also recognize us from our frequent appearances on CNBC, Bloomberg TV, and Canada's Business News Network. We've been quoted in a number of major publications, including Barron's, Forbes, the New York Times, and the Washington Post. We're sought-after speakers at investment conferences all around North America. And we currently serve tens of thousands of investors worldwide through our financial research firm, Capitalist Times. I've dedicated my career to analyzing and identifying profitable investment opportunities in the energy sector. The official program of the 2008 G8 Summit held in Hokkaido, Japan, even called me, quote, the world's leading energy strategist. Over the past year, I've developed something of a reputation for helping investors avoid dangerous energy stocks, for warning about the downside risks in crude oil and natural gas prices. You see, while many pundits and analysts think the weakness in the energy patch only began last summer as crude oil prices began to weaken, that's not the case, not at all. Roger Conrad and I started to hear of some worrying trends as far back as the end of 2013. A time when many thought all was just smelling of roses in the energy patch. In fact, you may recognize me or my firm from a free video we published about a year ago advising investors to avoid Seadrill, a company that leases drilling rigs used to drill oil wells in the deep water. That video racked up thousands of views on YouTube in just days. Similar articles about Seadrill I posted on popular financial websites like Seeking Alpha generated tens of thousands of page views and hundreds of comments. At an investment panel in Las Vegas last May, I even made Seadrill one of my top 5 stocks to avoid, predicting the firm would be forced to slash its dividends to preserve cash amid a deteriorating deepwater market. Many listened politely as I presented my research. Some got angry, but few were willing to accept my conclusions. You see, a year ago, Seadrill was a very popular stock, and many investors found my conclusion that the driller would be forced to slash its dividend payout absolutely shocking. After all, the firm's fleet of modern, high-tech drilling rigs are exactly what big energy companies need to drill for oil in a red-hot deepwater plays like the pre-salt fields of Brazil, the Gulf of Mexico, and West Africa. A year ago, the stock offered a sky-high yield of nearly 11%. And many of my peers were advising investors to load up on the stock. One prominent analyst even made the stock his top recommendation for 2014. Many pundits dismissed my research, showing that an oversupply of rigs, even the most technologically advanced deepwater rigs, was building and building fast. No one believed me when I said it was time to take profits in Seadrill due to deteriorating demand and excess rig supply in the deepwater drilling market. Some sneered just a few short weeks ago when I warned again and again Seadrill's dividend wasn't sustainable over the long run and the stock could halve in value. But on the day before Thanksgiving 2014, Seadrill discontinued its dividend, losing 23% in a single trading day. The stock has plummeted 70% since I recommended taking profits more than a year ago. And few believed me in early December, less than 3 months ago, when I called for oil prices to tumble under $50 per barrel. You see, back in early December, crude still traded for nearly $70 per barrel, and most pundits were calling for prices to bottom out no lower than the mid-60s. Those same pundits were scratching their heads and licking their wounds once again when West Texas Intermediate crude oil plummeted below $45 per barrel by mid-January, taking most energy stocks down with it. But I didn't create this video to boast or brag. I reference our success and experience analyzing the energy markets because we believe there are some dangerous risks in high-yield MLPs and other energy groups right now. And what really has me concerned, no make that worried, is that the mainstream media is completely ignoring these risks, just as they ignored the glaring warning signs in stocks like Seadrill a year ago. So let me ask you, will you act now to protect your portfolio? I hope so, and that's why I created this video. I urge you to watch this video through to the end, and I'll explain 5 surprisingly simple steps you can take to avoid the worst of the crisis and take advantage of some unique opportunities for profit. But I'm getting ahead of myself just a bit. Let me take a step back and tell you about a shocking conversation I had with an energy industry insider recently. Listen, just a few weeks ago, I received an email from a regular guest on my radio show, Capitalist Times Radio. He's a trader for one of the world's largest energy companies, a company that's a household name for most Americans. I don't mean to be so vague and secretive. However, he's asked us to keep his company affiliation private. Like all my contacts in the energy industry, I always listen to what he has to say. But this email absolutely made my jaw drop. You see, this energy VIP told me that he just got back from a hunting trip. A trip he took with around a half dozen other executives at major energy firms and master limited partnerships. As you can imagine, the conversations they had weren't just about deer. They also discussed a worrying trend underway in the energy industry right now. While it's related to the collapse in oil prices, energy producers like Continental Resources and oil services firms, it's actually far, far more dangerous. It's more worrying because it impacts a group of stocks that are enormously popular with income investors, and particularly those looking for a way to earn safe income for retirement. I'm talking about midstream master limited partnerships, or MLPs. Just remember, these are the high-yield, tax-advantaged companies that own crucial, basic, energy-related infrastructure like pipelines, natural gas storage caverns, and oil terminals. These companies are often compared to toll takers. They charge fees to move and store oil, and those fees have no relationship to the price of oil they're transporting. Typically, these fees are locked in under long-term contracts. These contracts, in turn, contain provisions known as capacity reservation fees. In English, that just means companies shipping oil have to pay the owner of the pipeline regardless of how much oil or gas they transport. Pay attention. Producers must pay the pipeline owner whether they ship thousands of barrels of oil per day or absolutely no oil at all. They must pay these capacity reservation fees whether oil trades for $150 or $30 per barrel. Sounds like an incredibly reliable and safe source of cash flows for the pipelines, right? But there's a nasty little catch. A very big risk my contact and his peers on this hunting trip discussed. A risk that's still a secret to most investors. You see, while many MLPs tout their long-term contracts, while these MLPs highlight the predictability of their distributions paid thanks to capacity reservation fees, some of these contracts simply aren't worth the paper they're written on. Listen, a year ago, many small producers and fast-growing shale basins were worried about having enough pipeline and storage capacity in place to handle all of the growing volumes of oil they were producing. In fact, the situation became so dire that oil produced in certain parts of the U.S., I'm talking about places like West Texas and North Dakota, traded at $10, $20, or even $40 or more price discounts to the exact same oil priced on the Gulf Coast. You see, there just wasn't enough pipeline capacity to accommodate America's shale boom. Gluts of crude developed in certain parts of the U.S., depressing prices. But with oil at $80, $90, or $100 a barrel, many of these smaller producers were still rolling in cash. Banks were eager to lend these shale producers money to finance new drilling projects. They didn't see a problem with signing deals to pay a pipeline MLP huge fixed fees to transport their output. They were more concerned with securing capacity than a drop in crude oil prices. However, oil prices are now well under $50 per barrel in many of these markets. Profits and cash flows these small producers enjoyed just a year ago are little more than a dream today. Banks aren't so willing to lend money to energy producers. In fact, many banks are now worried the collapse in oil prices will result in a growing pile of bad loans. Simply put, many of these shale producers can't pay their transportation bills. Even the producers on a relatively sound financial footing are looking for any way possible to conserve cash. Shale producers are starting to prepare for a prolonged period of lower oil prices. These producers are now going back to their counterparties. That's the midstream MLPs that own the pipelines and terminals, asking for discounts. Of course, the MLPs with these long-term contracts in place could refuse to grant discounts and insist on receiving their capacity reservation fees as agreed. But let me ask you, if their customers can't pay their bills and are forced into bankruptcy as a result, how much do you think these pipeline tariff contracts with MLPs are worth? Yep, that's absolutely right. Absolutely nothing. So you're going to see these contracts renegotiated. You're also going to see some producers desperately look to sublet some of their capacity on pipelines at deeply discounted prices. These producers can't afford to pay their bills at $50 per barrel, and they'll be looking for any way possible to conserve cash. Just consider this. Do you remember back in 2005 and 2006 when many pundits were saying that American consumers would never walk away from their mortgages? Sure, they might stop paying their credit card or car loans, but there's no way they would just allow banks to foreclose on their homes, right? Those mortgages, like capacity reservation fee deals, were supposed to be good contracts too. Many pundits recommended that investors buy groups like the home builders and banks back in 2008 because concerns in the mortgage market were overblown. But then, when everyone realized many borrowers couldn't make good on their debts, the entire system nearly collapsed. Between early 2006 and early 2009, the S&P Home Building Index plummeted more than 82%. Over the same time period, the KBW Banking Index fell nearly 90%. Of course, many big financial companies are no longer even with us today, including Lehman Brothers and Bear Stearns. Simply put, once investors realized many mortgages were backed by consumers unable to pay their debts, the market was in big trouble. We'd hit a tipping point. So let me ask you, what do you think is going to happen to many of these midstream MLPs when their debt-laden customers start renegotiating pipeline tariffs? What's going to happen when investors realize these long-term pipeline contracts are a form of debt? If these shaky customers can't pay and have to default, these deals are next to worthless. I believe we're nearing that same devastating tipping point for some midstream MLPs. Recently, Roger Conrad and I authorized an extensive research project into midstream MLPs vulnerable to contract defaults and found my contact, the Energy Insider, is absolutely correct. Even with crude oil under $80 a barrel for just a couple of months, there are already reports that smaller shale producers are looking for relief on their midstream contracts. It's only a matter of time before some high-yield midstream MLPs are forced to slash their distributions to conserve cash flow. Even worse, we found some of the most vulnerable names are midstream MLPs being widely recommended to investors as safe income plays. I don't have time to go through all the details of the riskiest midstream MLPs in this short video. However, we've assembled a report detailing the most vulnerable high-yield midstream MLPs, and we've called it Ticking Time Bombs. These MLPs are hazardous to your wealth, and I'll gladly give you access to a copy absolutely risk-free. Please don't buy any midstream MLPs until you at least read through this detailed report. And I'll show you how to get this crucial report absolutely risk-free in just a second. But first, the fallout from the energy price collapse stretches far beyond the high-yield pipeline MLPs. Consider the case of High Crush LP. This partnership sells proppant sand, a key resource used to coax oil and natural gas from America's prolific shale fields. Just a few short weeks ago, many of America's largest shale producers were struggling to secure enough proppant sand to meet demand. Prices for this crucial resource were on the rise, and suppliers like High Crush were soaring. From November 2012 through September of 2014, High Crush shares returned nearly 450%. That's pretty incredible, right? High Crush currently offers a yield north of 7%, an attractive distribution in today's pay-nothing world. Even as crude oil prices started to fall sharply last fall, and we began to hear the first talk of softening demand for proppant, many pundits argued High Crush was immune. No one believed me in November when I said the popular fracturing sand companies, including High Crush Partners and US Silica, would be the next casualties in the energy markets. You see, like many midstream MLPs, High Crush and US Silica have said that long-term contracts with producers shelter their cash flows from near-term weakness in proppant prices. But again, let me ask you, what are those contracts really worth? Look, the biggest customers for the proppant producers are the three largest services firms. That's Schlumberger, Halliburton, and Baker Hughes. In Schlumberger's conference call on January 15, 2015, management was asked if the company was attempting to negotiate price discounts with suppliers, including proppant sand companies. Schlumberger's respected CEO, Powell Kibsgaard, had this to say, and I quote, "Absolutely. And over the past 3 years or so, We have fully centralized our shared services and supply chain organization, including global category management. So we are fully leveraging, firstly, our buying power, and secondly, I would say, a highly capable supply chain organization to drive a similar type of discussion with our suppliers as to the discussions we have with their customers. So you might ask, what exactly does that mean? Well, shale producers are coming to Schlumberger complaining they can't make money with crude at $50 or $60 a barrel. They're asking Schlumberger for discounts on key services used to drill shale wells and put those wells into production. Schlumberger isn't just going to eat the cost of those discounts. Instead, they're passing some of the pain along to their own suppliers. That includes, you guessed it, proppant firms like Hi-Crush. And Schlumberger is a massive customer for all the proppant sand companies. That's what CEO Pal Kibsgaard meant when he said the firm would, quote, leverage buying power. Again, here's the key question. Are the sand companies really in a position to say no to their largest customers? Look, this is similar to how Walmart, the world's largest retailer, does business. To keep its everyday low prices pledge to consumers, the retailer demands annual price reductions from suppliers. While suppliers could refuse to supply their products to Walmart at ever lower prices, the retailer is a dominant customer with many of its suppliers. Do you think most suppliers are willing to hold the line on prices if it means giving up 20%, 50%, or even more of their sales volumes? Of course not. Walmart is able to leverage its scale and buying power to demand the best deals possible from suppliers. And Schlumberger can leverage its own size and scale to demand price reductions from its suppliers, just like Walmart does in its industry. When proppant companies start cutting prices charged to key customers like Schlumberger, the illusion of safety in long-term supply contracts will be shattered, and the stocks could fall another 50% from current prices. It's not a matter of if, but when we hear of the first contract renegotiations. And that brings me to this. Over the past few months, as you might expect, my firm has done a ton of research on commodity price cycles. We've looked at prior downturns in oil prices. However, we've also looked at cycles in corn, soybeans, natural gas, and other commodities. Even cycles in stocks, bonds, and other financial assets. Virtually all of these cycles share one common trait. Simply put, the recent rally in crude oil prices and energy stocks is what many veteran traders call, somewhat indelicately, a sucker's rally. Allow me to explain. March 27th of 1980 is a day known as Silver Thursday. You see, starting in the late 1970s, Nelson Bunker Hunt and William Herbert Hunt, sons of a Texas oil billionaire, began buying up silver, anticipating a continued surge in inflation and a plummeting US dollar. By early 1980, it's estimated that the two brothers controlled more than 60% of the entire US market for silver at the time, some 195 million ounces. Of course, they accumulated that position by leveraging their family fortune, and even taking on pools of cash from outside investors. They even raised money from Saudi investors. Silver prices skyrocketed, reaching highs of close to $50 per ounce by early 1980. Tiffany's, the jeweler, even took a one-page advertisement in the New York Times condemning the Hunt brothers' manipulation of the silver market. Some Americans began melting down their silverware to take advantage of the sky-high cost of the precious metal. However, high silver prices, coupled with the Hunt brothers' high-profile efforts to buy the metal, led to a devastating chain reaction of events. The government and futures exchanges eventually intervened, making it more costly for the Hunts to continue borrowing to finance their massive position. Then silver prices topped out and began to fall. That reduced the value of the collateral the Hunts were using to finance their massive position in silver. Their lenders forced them to cough up more cash to maintain their position in silver. And on Silver Thursday, the brothers finally missed a margin call, and the bottom dropped out of the silver market. You see, the brothers simply couldn't continue paying the cost of financing their position in silver. Their corner of the market was broken and prices collapsed. Of course, traders could smell the Hunts were in trouble. They shorted silver to take advantage of the decline in silver prices, once the corner was broken. Silver prices fell sharply, reaching a low under $11 an ounce by May 23rd of 1980. But then something weird happened. While the silver market still faced a glut as a Hunt's position would need to be unwound, silver prices bottomed. Between May 23rd and the following September, silver prices soared over 116% to $23.54 per ounce. So you're probably wondering what caused that rally. In this case, a good bit of the initial move was due to short covering. In other words, traders who short silver to take advantage of the decline once the Hunt brothers' corner of the market collapsed, decided to take profits on their positions. To cover shorts and book profits, these traders must buy silver, pushing prices higher. Unfortunately, a lot of unwitting traders got suckered into this move. You see, silver probably looked pretty cheap to some after falling from nearly $50 per ounce to less than $11 per ounce in a matter of less than 6 months. Some investors undoubtedly thought the bottom was in for silver. But that's not at all what happened. You see, the fundamentals for silver were still very negative. U.S. inflation peaked in early 1980 and was already falling by September 1980. Meanwhile, supply of the metal was increasing. That's all those silver platters and forks people melted down to sell at sky-high prices. And of course, the Hunt brothers took nearly a decade to unwind their massive position in silver, losing billions of dollars in the process. Without that artificial, debt-fueled demand, there was nothing real to prop up silver prices. So at the end of September 1980, silver prices resumed their slide. Silver fell another 65% between September 1980 and the summer of 1981, less than a year later. Silver eventually slid to well under $4 per ounce. Investors who bought the so-called suckers rally in the summer of 1980 were crushed. Silver isn't an isolated example. Between March and May of 2000, the Nasdaq Composite plummeted nearly 37% as the technology bubble of the late 1990s finally burst. In May, most Nasdaq stocks were still extremely expensive by any historic norms. Networking giant Cisco, for example, still fetched over 90 times earnings in May 2000. And spending on technology still looked to be weakening. Yet the Nasdaq bottomed on May 23, 2000, and jumped over 1,000 points, that's more than 30%, in less than 2 months. While the initial rally was driven by shorts covering their positions, a lot of pundits were advising investors to take advantage of the dip to buy tech stocks in the summer of 2000. Those who bought the Nasdaq suckers rally watched the tech-heavy index nosedive more than 65% from its July 2000 highs to March of the following year. And the Nasdaq plummeted a total of about 75% from its July 2000 highs to its ultimate lows in late 2002. Or how about corn prices over the past few years? After weather-related shortages eased in 2013, corn prices plummeted by about 50%, fallen from over $8 per bushel in mid-2012 to just over $4 per bushel by the end of the following year. In early 2014, corn prices saw a suckers rally, jumping 25% from their lows. Guess what happened next? Yep, the fundamentals had not changed. In fact, the U.S., the world's largest corn producer, saw excellent growing conditions last year and produced a record crop. Once again, the oversupply of corn eventually weighed on the market and sent prices plummeting another 37% to about $3.25 a bushel. Look, markets rarely move in straight lines. We've tracked the history of major price declines in all sorts of commodities and financial assets over the past few decades. Our research confirms, in virtually every case, major sell-offs over a short period of time are followed by a significant bounce and then, finally, a second wave of selling. Sometimes there are even several counter-trend rallies in the midst of a longer-term downtrend or bear market. That's pretty incredible, right? So let's get back to today and the current market for oil. U.S. West Texas Intermediate crude oil prices have fallen nearly 60% from a high of $107.62 per barrel in July last year to January lows of $43.82 per barrel. But since mid-January, oil prices have rallied, and so have energy stocks. WTI touched highs close to $54 per barrel in February, and Brent crude oil rallied over $60 a barrel. The S&P 500 Energy Index jumped nearly 15% from January lows to February highs. The Alerian MLP Index was up a similar amount. However, check out this chart from the Commodity Futures Trading Commission, or CFTC. This chart shows the short position of non-commercial traders, that is speculators, in the NYMEX oil futures market. Between late December and late January, this short position jumped by nearly 75,000 contracts. The higher this number, the more these speculators are betting that WTI prices will decline in value. However, in late January, many of these traders decided to cover their shorts and take profits on their successful trades. The short position for non-commercials fell. That means these traders had to buy oil futures to cover their shorts, forcing oil prices higher. Just like silver prices in May 1980, the NASDAQ in 2000, and corn prices just last year, the recent rally in oil is just a sucker's rally, driven by short covering. Please make no mistake about it, the fundamentals of the crude oil market have not improved. Look, I know there are plenty of pundits trying to call a bottom in crude oil prices. They're trying to catch that falling knife. I could throw up 100 charts to show you exactly what's going on in every corner of the crude oil market. However, only two simple charts are really necessary. First, check out this chart of U.S. oil inventories. This is just a measure of crude oil in storage in the U.S. Well, suffice it to say, there's a record amount of oil in storage in the U.S. right now. There's about 426 million barrels of oil in storage in the U.S. alone. The prior record for U.S. oil storage was about 390 million barrels in 1990 and again in 2013. The International Energy Agency, or IEA, also tells us that oil inventories across the developed world are way above average for this time of year. So why is all this oil going into storage anyway? It's simple. Global oil production exceeds demand, so the difference, as much as 3 million barrels per day. Of course, there's some speculation out there that U.S. oil production will soon begin to fall as producers cut back on drilling activity in America's prolific shale fields. Well, that brings me to my second chart. Weekly oil production data from the Energy and Information Administration confirms that U.S. oil output is at the highest levels in 3 decades, nearly 9.3 million barrels per day. So you're probably wondering, what about the drop in the U.S. rig count, the number of rigs actively drilling for oil in the U.S.? Won't a decline in the rig count result in a decline in U.S. oil production? Well, that's a great question. The number of rigs drilling for oil in the U.S. has fallen at a record pace over the past few weeks. But here's the problem. Most of the oil rigs that have been idled are in less productive plays. Most aren't the most advanced rigs in the core of the Bakken Shale of North Dakota or the Eagle Ford Shale of southern Texas. These super productive rigs are still drilling, and productions from these mega wells has and will continue to rise for at least another 6 to 12 months. Simply put, crude oil prices will need to fall to $30 per barrel and remain under $50 per barrel for much of 2015 to ensure that U.S. production falls enough to alleviate the global glut of oil. In virtually all cases we studied, these counter-trend rallies, that is, the so-called suckers rally, only lasted 1 to 3 months. That's right, our research confirms that it's a matter of just days before oil and energy stocks resume their slide. Let me ask you a question. Will you act now to protect your portfolio? I hope so, and that's why I wrote this letter. So what can you do? Well, I've done a ton of research on this, and I've found that there are a surprising number of simple things you can do to not only protect what you've currently got, but also potentially make quite a bit of money as oil prices continue to fall this year. Here are 5 simple steps I'm recommending. Profit step number 1, the energy market's ticking time bomb. The first step is to focus on preserving your wealth. You must avoid the energy stocks that are getting crushed in this bear market. I'm talking about stocks like the high-yield pipeline MLPs that will be forced to renegotiate their pipeline tariffs as shale producers struggle with falling oil prices. Look, as I just explained, it's only a matter of time before investors wake up to the fact that contracts signed with shale producers aren't worth much when those producers are struggling to pay their own bills. However, there's a bit of good news. The current suckers rally in crude oil, energy stocks, and many midstream MLPs offers investors a golden opportunity to get out of vulnerable names right now. Please understand that there's only a short window to act now before the next wave of the energy crisis unfolds. Once we hit that tipping point, it'll be too late. Listen, Roger and I have assembled a comprehensive report detailing the most vulnerable high-yield midstream MLPs called Ticking Time Bombs. These MLPs are hazardous to your wealth. Please let me send you a copy of this report with absolutely no risk or obligation before it's too late. I urge you to read this report before you buy any more midstream MLPs, and I'll explain how you can get a copy today in just a moment. Of course, even quality large-cap energy stocks like Schlumberger will get hit in this downturn. While Schlumberger is a great long-term holding, you must buy this company at the right price to make money. Schlumberger is only a great opportunity if you understand how this cycle is going to play out over the next few months. That's why I've prepared a second report, also available risk-free, called Schlumberger, Best in Class, but Exercise Caution, that explains in great depth exactly how you should approach buying stocks like Schlumberger. Simply put, Schlumberger is not a safe buy at current prices. Before you pull that trigger, I urge you to take a look at the detailed research I've assembled in our report called Schlumberger, Best in Class, but Exercise Caution. Profit step number 2, hedging your bets. What if I told you that one stock we recommend as a play on falling oil prices has soared 60% since mid-October alone? Would you be interested in hearing more about that kind of opportunity? Let's be honest. While the sector has performed well in recent years, energy stocks still account for less than 10% of the S&P 500. Many of the remaining 90% of stocks and sectors can benefit from lower oil prices. However, only a small handful of names are actually getting a game-changing boost from lower oil prices. The sort of tailwind that's already powered gains of 100% or more from some of our top hedge recommendations. I don't have time to go through all the details of our top plays on lower oil prices in this short video. However, I will explain everything in full detail in my new report called Hedging Your Bets, Stocks That Thrive When Oil Dives, and I'll gladly give you access to a copy, again, absolutely risk-free. And I'll show you how to get this valuable report risk-free in just a second. In addition, I've just prepared a brand new report on a weird little niche of the energy industry, a high-yield group that has been through a vicious down cycle since 2008, a downturn that resulted in several bankruptcies among major players in the sector. However, this overlooked energy subsector is now quietly entering a brand new upcycle. With most pundits busy trying to call a bottom in oil prices, few are even discussing this group. This is an aggressive recommendation that's definitely not for everyone. However, the last time this group entered an upcycle, between 2002 and 2005, some stocks in the group offered returns of more than 2,000%. Look, I know you're probably thinking I'm exaggerating and that this sounds way too good to be true. And to be fair, I'm not looking for gains that large over the next 12 months. But my research points to potential gains of 50% to 100% in the best positioned stocks in the group. Look, I'm talking about the crude oil tanker industry. I don't have time to explain exactly why I like this group in this short video. However, I'll give you all my research in a hot-off-the-press special report called High Yields on the High Seas, Profit from the Turnaround in Tankers. I'd like to send you this report, including the names of my top tanker stocks to buy right now, also absolutely risk-free. And while I think many energy stocks are dangerous investments right now, there are a few groups that represent fantastic value. Which brings me to profit step number 3, pull these babies from the bathwater. How about the names of a handful of tax-advantaged, high-yield stocks that have been caught up in the energy price panic. A classic example of Wall Street throwing the babies out with the bathwater. These stocks are down for no good reason, offering investors the opportunity to lock in high, fast-growing yields by purchasing these stocks at discounted prices. I'm talking about yields of 4%, 5%, and even over 7% from rock-solid income gushers, with the potential to generate significant income growth over the next 3 years, regardless of where oil is trading. In our hot-off-the-press special report called Game Plan for Lower Oil Prices, Pull These Babies from the Bathwater, we'll unveil all the details of 5 of our top picks to buy right now at fire sale prices. Plus, I'd like to send you information on a secret high-yield asset class few are talking about, an asset offering yields of 13% or higher in some cases, and one that can actually benefit when some energy stocks are forced to cut their dividends and distributions. Profit step number 4, profiting from the pain, and collect a 13% yield. I've got to warn you, some pundits are actually telling investors to avoid this asset right now. Yet these securities offered huge returns the last time energy prices fell in 2008 and 2009. We expect total returns of 50% or more over the next 12 to 18 months. This opportunity is a little unconventional, but has been a favorite of wealthier investors for decades. I'd like to give you access to this valuable report detailing the secret asset class and strategy, also absolutely risk-free. I'll show you how to get it in a second. And that brings me to our 5th and final profit step to take right away. Profit step number 5, a certain winner in uncertain times, our favorite new MLP. Master Limited Partnerships, or MLPs, are a group of tax-advantaged, high-yield investments that have blown the S&P 500 out of the water over the past decade. Over the past 10 years, the industry benchmark Alerian MLP Index has soared 300%, compared to a gain of less than 118% for the S&P 500. However, we've identified one simple characteristic you can use to identify the top-performing MLPs. One MLP with this simple trait soared 1,160% over the past decade alone. That's enough to turn a $10,000 investment into nearly $120,000. Another MLP we identified with this same golden characteristic has jumped over 150% since going public just over 2 years ago. That's close to 5 times the return for the S&P 500. You'll be shocked at how well this one simple trick for identifying the top-performing MLPs works. And we've included all the details of this strategy and one of our top MLPs to buy right now in our special report, available risk-free but only for a limited time. Please just give the work I've done a look. Read my 7 special reports, and I believe you will have all the information you need at your disposal. The best part is, you can take a look at my research and receive everything I've mentioned here at absolutely no risk or obligation. Simply let me know that you'd like to take a trial subscription to our service, Energy and Income Advisor, and I will immediately give you access to all 7 of our newly released research reports. Click the green Subscribe Now button below this video and test our service for 30 days. Download all 7 of our special reports. Read 2 detailed monthly issues of Energy and Income Advisor. Gain exclusive access to our model portfolios, offering suggested allocations for growth, income, aggressive, and conservative investors. Read through our extensive archives. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, the economy, or individual stocks and bonds and have your questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It's still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks, our recommendations, the economy, or even the broader market itself. Ask any question you like, and we'll answer every question we're asked on the chat. Last month, we were online for more than 7 hours, answering questions posed by subscribers. Our next scheduled online chat is coming up in just a few days. Just enough time for you to read our research and prepare any questions you have. Click the green Subscribe Now button below this video Sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you the details of how to log on to our exclusive subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. What have you got to lose? Test our service for 30 days, read our research, and join our monthly web chat, then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days, keep your 7 free reports, and I'll refund your full subscription price. Again, no questions asked. Here's to your wealth. To start your risk-free trial, please click the Subscribe Now button to the right of this video and join us today.